3 years ago, Sarah had $47,000 in the bank. She paid her rent on time. She paid her bills on time. She did everything right. Then she applied for a car loan. The bank said no. It wasn't because she couldn't afford the car. It wasn't because she had failed to pay anything back. It was because of a 3-digit number that Sarah had never even heard of. A number that lives in files she's never seen. A number that has more power over her life than any decision she's ever made. That number is called a credit score. And the terrifying part? The system that produces it was designed before you were born. It operates in the shadows. It controls whether you get a house, a car, or even a decent apartment. And almost nobody understands how it actually works. Today we're going to pull back the curtain on one of the most absurd financial systems ever created. Let's start with a basic question. What is a credit score? A credit score is a number between 300 and 850 that's supposed to predict your likelihood of defaulting on borrowed money. That's it. That's the job. A 3-digit prediction about your future behavior. But here's where it gets weird. This number doesn't measure your intelligence. It doesn't measure your income. It doesn't measure your actual financial health. It measures one specific thing: how reliably you've borrowed money in the past. And that measurement has become absolutely foundational to modern American life. The average American checks their credit score 5 times a year. 4 out of 5 Americans believe their credit score should affect their job prospects. That's insane. Yet it kind of already does. Some employers check credit reports. Insurance companies use credit scores to determine your rates. Landlords reject applications based on them. It's a numerical score that follows you everywhere. You've probably heard the term thrown around, but you almost certainly don't understand how the number gets calculated. And you're not alone. The Federal Reserve conducted a study and found that most Americans don't actually know what goes into their score. They think they know, but they don't. They're guessing. And here's the catch: the companies that calculate your score aren't required to fully explain how they do it. That's not speculation. That's law. Credit scoring. Companies are allowed to keep their formulas secret, proprietary, protected. Your future is controlled by math you're not allowed to see. Let's fix that. The credit score didn't exist until 1989. Think about that. For the entire history of human civilization, for thousands of years, lending worked based on relationships and judgment. A banker knew you. A banker trusted you. Or a banker didn't. That was it. Then in 1989, the Fair Isaac Corporation released the FICO score. FICO stands for Fair Isaac and Company. And the name is arguably ironic, given what we're about to discuss. But in 1989, the FICO score changed everything. For the first time in history, lending decisions would be made by an algorithm. Not a person. An algorithm. A mathematical formula that would attempt to predict your future behavior based on your past behavior. And the banks loved it. Because algorithms are cheaper than employing thousands of loan officers. Algorithms don't have bias. Allegedly. The formula wasn't perfect. Nobody claimed it was. But it was scalable. And scalability is more profitable than accuracy in the financial industry. Here's what actually happened: credit became democratized. Mortgages became easier to get. Car loans became easier to get. Credit cards exploded in America. For the first time, people who didn't have a personal relationship with a banker could access credit. And that sounds good. And in some ways it was. But it also meant that your financial destiny was now in the hands of a mathematical formula that nobody could see. And that formula was making mistakes. A lot of mistakes. By the time most Americans realized the credit score even existed, it had already determined how much interest they'd pay on everything, how much their insurance would cost, whether they could rent an apartment. The horse had left the barn. And we were all just discovering there was a horse. Okay. So your credit score is calculated by 5 factors. And the percentages are public. But the weights can vary by institution. So take these numbers with a grain of salt. They're guidelines, not rules. Payment history is 35%. This measures whether you've paid your bills on time, not whether you've paid them all just on time. You miss one payment and it stays on your report for 7 years. Literally 7. A mistake at age 25 can haunt you until you're 32. A missed payment from a medical bill you didn't even know about can drag your score down for 7 years. Credit utilization is 30%. This is the ratio of debt you're carrying versus your total available credit. The formula says you should ideally be using less than 10% of your available credit. So if you have a credit card with a $5,000 limit, you should keep your balance below $500. But here's the weird part. Using $0 is almost as bad as using too much. The algorithm actually wants to see that you're borrowing money. If you're not borrowing, it can't predict whether you'll pay it back. So the score kind of penalizes people who don't need credit. Length of credit history is 15%. This rewards people who have maintained credit accounts for a long time. It punishes people who are new to credit. You could be 40 years old with a 6-figure income and no debt, but if you just got your first credit card, you have a worse score than someone who's 25 and has been borrowing since they were 18. Credit mix is 10%. This measures the different types of credit you have: mortgages, car loans, credit cards, student loans. The algorithm likes to see you managing multiple types of debt, because managing diverse debt is theoretically harder than managing one type. So the formula rewards complexity. It rewards borrowing. And finally, recent inquiries are 10%. This measures how many times you've applied for new credit recently. Shopping for a car. You visit 5 dealerships. 5 hard inquiries. Your score drops. So now you have worse credit. So now you have to pay a higher interest rate because you had the audacity to shop around. Let's talk about what's missing from this list. Your actual income isn't in there. Your savings account isn't in there. Whether you own property isn't in there. The fact that you might have gone through a medical bankruptcy isn't nuanced. It's just marked as default. The fact that you might have lost a job isn't noted. It's just marked as a missed payment. The algorithm doesn't know why you failed to pay. It only knows that you failed. And here's the thing that really gets weird. These 5 factors are proprietary. The exact weights they use? The exact formula? The exact threshold for what? Moves your score up or down? None of it is public. Each credit bureau calculates slightly differently. Equifax calculates differently than Experian, which calculates differently than TransUnion. And they're not required to tell you how. So somewhere right now, a mathematical formula that you're not allowed to see is determining your financial future. And you're supposed to be okay with that. Here's what nobody tells you. The credit score system isn't actually designed to help you get credit. It's designed to maximize profits for lenders. Think about it this way. If the system was designed to accurately predict default risk, it would give good credit scores to people who reliably pay their bills and bad credit scores to people who don't. That would be fair. That would be logical. But that's not how it works. Instead, the system is calibrated to extract maximum profit from the maximum number of people. The people with bad credit pay higher interest rates. Much higher rates. A person with a 620 credit score might pay 8% interest on a car loan. A person with a 720 score pays 4%. That's a difference of $3,500 on a $30,000 car over 5 years. For one number. Over a decade of that person's life, the extra interest compounds. And all of it is justified by a formula they're not allowed to see. And here's the truly insidious part. The people who benefit most from credit are the people who need it least. Wealthy people can access cheap credit because they already have money. Poor people pay high interest rates because they don't. And the credit score system crystallizes that inequality. It locks it in place. It makes it permanent. It's a system designed to transfer wealth from those who have less to those who have more. And it's hidden under the guise of mathematical objectivity. Then there's the bureau itself. There are 3 major credit bureaus in America: Equifax, Experian, and TransUnion. They collect your financial data. They sell it to banks, insurance companies, landlords, and employers. They literally profit from your information. And you have almost no control over what they collect. And here's the thing that happens in practice. You become responsible for monitoring data that you don't control, calculated by a formula you're not allowed to see, held by companies you've never agreed to, sold to institutions you'd don't know, for profit that doesn't benefit you. If an error appears on your credit report, it's your job to fix it. Not the bureau's job. Your job. You have to dispute it. You have to provide evidence. You have to prove that the data is wrong. And the bureau has no financial incentive to agree with you. They get paid either way. Let's talk about what happens in the real world. In 2008, millions of people lost their jobs. They couldn't pay their mortgages. Their credit scores tanked. Now, They're unemployed and their credit score is destroyed. So when they finally find a job, they rent an apartment. The landlord checks their credit. And the landlord says no. Why? Because of events that happened 3 years ago when the person had no income. That's not prediction. That's punishment. Or imagine this. You're young. You've never borrowed money. You want to build credit, so you get a credit card. You put one charge on it and immediately pay it off. Your score goes up slightly. You do this for months. Your score keeps going up. But it's going up slowly because you don't have a long history. Then you want to buy a house. You get pre-approved for a mortgage. The mortgage is 2%. But because your credit history is short, you have a credit utilization ratio issue or some other factor that wasn't even your fault. Your rate goes up to 2.5%. Over 30 years on a $400,000 house, you pay $60,000 more in interest. Because the system punishes people who don't have a long history of borrowing. The credit score system has created a catch-22 for millions of people. You need credit to get credit. You need a history of borrowing to get favorable rates on borrowing. And if you're new to the system or you've had hard times, you're stuck in a mathematical trap that keeps you paying more for everything. Forever. And the worst part? This system is defended. Economists defend it. Banks defend it. The government defends it. They say it works. They say it's fair. They say the free market has spoken. But the free market hasn't spoken. The free market has been coded into an algorithm. This matters beyond just money. A 2022 study found that credit scores predict access to housing, employment opportunities, and health outcomes. They predict your ability to get certain jobs. They predict your insurance rates. Some employers won't hire you if your credit is below a certain threshold. Not because it affects your job performance, but because of some assumed correlation between credit scores and trustworthiness. That's not science. That's superstition dressed up in mathematics. And here's what's happening right now. Inflation has made it harder for people to pay their bills. Auto insurance rates have soared, making it hard to afford payments. Medical debt is crushing millions. Credit scores are dropping across the board. And as millions of people's scores drop, their interest rates on mortgages, car loans, and credit cards go up, which makes it harder to pay their bills, which drops their score further. And the system accelerates the inequality it's supposed to measure. It's not a neutral arbiter of creditworthiness. It's a machine that takes people who are struggling and makes them struggle more. And yet we're stuck with it. We can't opt out. There's no alternative. You have to participate in a system you don't understand, can't see, and have no control over. And it determines enormous portions of your life. That's not a market. That's an infrastructure of control wrapped in the language of objectivity. Sarah got her car loan eventually. It took 6 months and 3 rejection letters. She had to pay a higher interest rate. She paid thousands more in interest than someone with a good credit score would have. For the same car. For the same risk. The question isn't whether the credit score system works. It clearly works. It works exactly as designed. The question is whether we've ever stopped to ask whether it should work this way at all. And that's something worth thinking about.